Good afternoon. Today we're going to discuss Chapter 6, entitled Audit Planning, Understanding the Client, Assessing Risk, and Responding. And so in this chapter, we will discuss the major steps in the audit process, which include obtaining the client, planning the audit, assessing the client, and assessing the risk of material misstatement and performing audit procedures. So obtaining a client, first clients normally will solicit for new auditors, and auditors will submit a proposal. And so while you're submitting a proposal, you will also um, assess the company by contacting the previous auditors. And so you will contact them and discuss topics such as integrity of the management of the company, any disagreements over accounting principles, communication to those charged with governance regarding fraud and noncompliance with laws, communication to management and those charged with governance concerning internal controls, significant deficiencies, and material weaknesses. The predecessor's understanding of reason for the change in auditor and any other topics that are relevant for the industry. Overall communication is important for evaluation of management integrity. So the engagement letter, once they come on as a client, of course, the engagement letter will have the name of the entity. It'll spell out management's responsibilities as well as the auditor's responsibilities. And so under management responsibilities, you'll have items such as financial statements, establishing effective internal control over financial reporting, compliance with laws and regulations, making all records and client personnel available to the auditors, providing written representation at the end of the audit regarding its responsibilities and belief that the financial statements are free from material misstatement. Under auditors' responsibilities, you have the auditors will conduct an audit in accordance with the GAS or PCOB, depending on standards, depending on if it's a public or a private company. Obtaining understanding of internal control to plan, audit, and determine the nature, timing, and extent of procedures, and then making communications required by auditing standards. So some optional items on the engagement letter consist of arrangements, other services or limitations, and any other type of condition. So under arrangements, you have conduct of the audit, use of specialists or internal auditors, obtaining information from previous auditors, fees and billing, um, other services to be provided, such as examination of internal control over financial reporting, any limitations or other arrangements regarding liability of auditors or client, and the conditions under which access to the auditor's working papers may be granted to others. So the audit process. So after obtaining a client, the audit process includes planning the audit, obtaining an understanding of the client and its environment, including its internal controls, assessing the risk of material misstatement, and design further audit procedures, performing those further audit procedures, completing the audit, and then forming an opinion and issuing the audit report. And so for this chapter, the emphasis is going to be on steps 1 through 3. So here we have our first diagram of the chapter, which is, I think, a very good diagram to use for your notes. It's going to list the steps 1 through 6 and is giving you examples. And so, one, of course, you're going to plan the audit, and that's establish an understanding with the client as to the nature of the engagement. You're going to develop a strategy, a plan, and a program. Next, you're going to obtain understanding of the client, its environment, and internal controls. So perform risk assessment procedures, including inquiries of management and others within the entity. Assess risk of material misstatement and design further audit procedures. And so here you're going to identify, assess risk of material misstatement for account balances, classes of transactions, and disclosures. Next, you're going to perform audit procedures. The approaches are test of controls, analytical procedures, and test of detailed transactions and balances. Then you're going to complete the audit. And so the audit procedures there are search for any unrecorded liabilities, review minutes of meetings, perform the final analytical procedures, and then form an opinion and issue the audit report. And so public company reporting requires reporting on internal control on the financial statements, and non-public accounting reporting ordinarily involves only reporting on the financial statements. So audit planning overall, you're going to develop an overall audit strategy and an audit plan. You're going to plan the use of client staff. You're going to plan involvement of other CPAs. You're going to arrange for specialists. And if it's a first year audit, you're going to communicate with the previous auditors and establish opening balances on the financial statements for all the accounts. So, in obtaining understanding of the client and its environment, you're going to perform risk assessment procedures, including inquiries of management, others within the entity, analytical procedures, observation and inspections relating to client activities, operations, documents, reports, and premises. Other procedures such as inquiries of others outside the company and reviewing information from external sources such as analysts, banks, rating organizations, newspapers, and journals. So understand the nature of the client. You're going to evaluate their competitive position, their organizational structure, accounting policies and procedures, ownership, capital structure, product and service lines, critical business processes, and internal controls. Industry regulation and other factors relating to the business. So again, competitive environment, supplier and customer relationships, technology developments, any major laws and regulations, economic conditions, and then attractiveness of the industry, any barriers to entry, strength of competitors, bargaining power of suppliers of raw materials and labor, and bargaining power of customers. So objectives, strategies, and business risks. And so you want to identify the objectives and their overall plans, operating and financial strategies, operational actions to achieve these objectives, and business risks and threats to achieving objectives. So measuring and reviewing performance, you're going to review the budgets, key performance indicators, variance analysis, segment performance reports, balanced scorecards, and external reviews of performance. Internal controls. Need knowledge and understanding of how a client's internal controls work, what controls exist, who performs them, how various types of transactions are processed and recorded, what accounting records and supporting documentation exists. And then the sources of information are going to come from inquiries of management, industry, accounting and auditing guides, industry risk alerts, trade journals, news stories, government publications, prior company annual reports and SEC filings, if it's a public company, prior tax returns, electronic sources, for example, FASB's website or other pages, tour of the plant and offices, preliminary analytical procedures, and a statement of cash flows. And so understanding the client's business and these different types of elements help frame the planning of the audit because it gives you an idea of risk factors. So determining materiality. Materiality is a very important issue. We've discussed it several times. You're going to use a professional judgment based on that of a reasonable person. Consider both quantitative and qualitative items when you're dealing with materiality. And so materiality is used in planning the audit at the overall financial statement level, allocate overall to performance materiality for individual accounts, and then evaluating audit findings. So the definitions of materiality based on FASB and PCOB. And so FASB, information is material if omitting it or misstating it could influence decisions that users make on the basis of financial information of a specific reporting entity. For PCOB, interpretation of a financial securities laws, a fact is material if there is a substantial likelihood that the fact would have been viewed by a reasonable investor as having significantly altered the total mix of information made available. And so assessing the risk of material misstatement and design the further audit procedures. And so the overall approach is to ask yourself what could go wrong, how likely is it that it will go wrong, and what are the likely amounts involved. And then particular things to consider are inherent risk of material misstatement due to fraud. It is presumed that there will be risk of material misstatement regarding revenue. And so when performing risk assessments, the auditors should be alert for significant risk that requires special audit attention. For these risks, the auditor should carefully consider internal controls, not rely on controls tested in prior periods, and not rely solely on analytical procedures to obtain evidence. And then you must also design further audit procedures as you see necessary. So assessing fraud risk, we talked about risk before in the previous chapter. So you have two types: fraudulent financial reporting, which is management fraud, or misappropriation of assets. So procedures to assess fraud risk: discussion amongst engagement team, inquiries of management and other personnel, risk assessment analytical procedures, and considering fraud risk factors, which are incentives, opportunity, and attitude of ability to rationalize theft. Responding to fraud risk. So there's an overall response. Audit, adjust professional skepticism in audit evidence, adjust personal assigned and supervision, adjust scrutiny given to accounting principles and predictability of accounting and auditing procedures. Alterations in audit procedures, and so more reliable evidence is needed, shifting timing to year end and increasing extent, which is the sample size. And so response to possibility of management override, you're going to examine journal entries, review accounting estimates for biases, and evaluate the business rationale for significant unusual transactions. Consideration of fraud throughout the audit. Continue to evaluate the risk of audit tests. And if you discover fraud, communicate to the appropriate level of management. If fraud involves senior management or material misstatement, communicate to the audit committee instead of senior management. And so it's designing further audit procedures. And so types, test of controls, analytical procedures, and test of details of transactions and balances. And so these procedures include, of course, analytical procedures, inspections, observations, inquiry, confirmations, recalculations, and reperformance. And we've discussed these in detail in the previous chapter as well. So further audit procedures should include a substantive procedures for all material relative assertions, test of controls when auditor's risk assessment includes an expectation that controls are operating effectively, or when substantive procedures alone are not sufficient. Procedures should be linked with the assessed risk of material misstatement at the relevant assertion level. An overall response when assessed risk of material misstatements are high. We should consider heightened professional skepticism, assigning more experienced staff, assigning staff with specialized skills, and providing more supervision. And we've discussed this in previous discussions about once you realize a company you're auditing is at a higher risk. And so these are some of the things that you can put in place to mitigate that risk. Again, that's to heighten the professional skepticism, assign more professional staff, assign staff with specialized skills, and provide more supervision. So an audit trail. It's a trail of evidence that links original recording of transactions, journal entries, and ledger entries. Auditors may follow the audit trail in either two directions related to the direction of the testing. And so test for existence of occurrence, vouching for transactions from recorded amounts to source documents, or test for completeness, which is tracing of transactions from one source document to recorded amounts. So transaction cycles. And so auditors' consideration of internal control is often organized around clients' major transaction cycles. So example, that's revenue or sales and collection cycle, acquisition and payment cycles, conversion cycles, payroll cycles, investing cycles, and financing cycles. This is an example of accounts receivable cycle. And so transactions affecting accounts receivable. And here you have the beginning balance. Then there's a cycle of time, a period of time when you're going to issue items on credit, and that's your sales entry here. And then a collection cycle where you're receiving cash, and that's relevant here. Sales and return allowance again, and uncollectible account write-offs, and then you have an ending balance. And so these are different here, and here are different cycles. So audit plan, you have systems portion, which deals with the client's internal control and evidence of test of controls and assessment of control risk. And you have a substantive test portion that deals with financial statement account balances, indirect and direct verification of income statement accounts. So here you have an illustration of indirect verification of income statement accounts. And so in this diagram along the top, you have your income statement items, the cash transactions, and the balance sheet items. To the left here, you have your financial statement relationship, and then the auditor's approach to substantiation. And so here, in the first column, you have revenue. Um, your revenue is equal to your cash receipts from customers, less beginning balance of accounts receivable, plus your ending balance of accounts receivable. And so this is the computation that you will follow to determine if the revenue amount is correct. And so verify indirectly by substantiating right-hand side of the equation. Also use analytical procedures, direct computations, and test of transactions. Here, the cash transactions you'll substantiate by testing transactions. Also perform reconciliations of cash accounts. Your beginning balances substantiate by reference to last year's audit working papers, and your ending balances are substantiated by substantive test in the current year. And so if you rework these equations, you'll come back to these balances to check them. So expenses are equal to cash payments for expenses, less beginning balance of accrued expenses and ending balance of accrued expenses, plus the beginning balances of prepaid less the ending balances of prepaid expenses, for example. So the relationship of financial statement assertions to the audit. And again, we've discussed this a couple of times. You have your financial statements following GAAP, and then you have some management assertions, the audit objectives, the audit procedures, audit evidence, and then an audit report on the financial statements from the auditors. This diagram explains the relationship among audit objectives, risk of material misstatement, and audit procedures. This is very good to have for your notes. Here you have your general audit objectives for assets, specific audit objectives for accounts receivable, which they're using in this example, risk of material misstatement, what could go wrong, and then an example of audit procedures. And so here you have the general audit objectives for assets are the existence of the assets, the rights to the assets, completeness of assets, the cutoff transactions, valuation of assets, and financial statement presentation of assets. And so specific objectives for accounts receivable are when you're dealing with existence of assets, for example, all recorded receivables exist. Then the risk material misstatements of what could go wrong, you have receivables may have been recorded that do not exist. And then an example of the audit procedures are confirm a sample of receivables by direct communication with debtors. And so you can follow this example for each one of these situations when it deals with accounts receivable. And so in summary, we discuss obtaining the client, planning the audit, obtaining an understanding of the client and its environment, including its internal controls, assessing the risk of material misstatement and design further audit procedures, and then performing the audit procedures.